Just call it AggieCon.
AggieCon Department of Michigan State.
That's what I call it.
And then we'll go through the calculator tool. So ask lots of questions. This is the time to do all your questions. Go ahead, Chris.
All right. Thanks, Faith. Good morning. So yeah, we're going to talk a little bit about margin protection program for dairy producers in 2018 because we've made some changes here in the last couple months, and there's an opportunity to sign up now under a revised program. So let's talk a little bit about that. So let's recall a little bit. I won't get into too much history, but the margin protection program for dairy producers was created in the 2014 Farm Bill. Right, and so it's existed since 2014. There was a sign up at the end of 2014 that was for a few months in 2014 and then 2015, right? And the intention was to help dairy producers have some risk management through this government program that protected a margin between the all milk price, so a U.S. all milk price, which is meant to be representative of your milk price, and a feed cost index. So it makes payments potentially when the average difference between the U.S. all milk price and national feed ration falls below some coverage level that you could select between $4, which you could get for free, and then $8 if you paid some premiums and 50-cent increments in between. So we were coming off a period at that time where we'd had a lot of feed price volatility in addition to milk price volatility. Lately, the feed price has been less volatile. Milk price hasn't been volatile lately, and that's part of the problem, right? Because when you're at the bottom, right? I mean, so generally people think volatility is bad, right? But if you're at the bottom, volatility can almost certainly be good, right? We'd like some, because it would have to go up. So, but that's a whole different issue. So there's 4 key elements to the margin protection program. The actual dairy production margin, which is that income over feed cost margin, which I'll get into in a moment. Actual production history, which is specific to your operation and has to do with how much milk you produced in 2011, 12, or 13. Covered production history, which you select, and then the coverage levels, and then the premiums that are associated with it. And the covered production history, which is the percent of your actual production history, and the coverage levels and premiums are your choice, okay, within certain bounds. So the actual dairy production margin is what they call this income over feed cost margin. And it's the U.S. all milk price, which in general is correlated with your price. Unfortunately, the last couple of years, Michigan's kind of mailbox prices have been lower than they used to be historically relative to the U.S. all milk price. And then a feed cost ration, which is a function of, in this case, the Nass U.S. corn price, and this price is received, the Nass alfalfa hay price, and the AMS, which is the Ag Marketing Service. These are all part of USDA. Central Illinois soybean meal, actually rail price in this case, because Nass does not report soybean meal prices for all the states. So this is meant to be kind of nationally representative. And you can see, for example, some regions have much higher feed prices than these U.S. averages, and some have higher milk prices. And so, there's always those kind of issues when you're making a national policy, And this is what it was based on, was a ration that was developed by nutritionists at universities and industry, and then it ended up getting adjusted a little bit at the end to make it through the budgeting process. So this is actually, as of a couple days ago, I didn't update it this morning, but this is what this is from Mark Stevenson's website, and I'm going to get into it later because that's where the decision tool is, the Dairy Markets and Policy website. But this is going back to January 2015, which is essentially the life of the program, what the margin has been. So this is $8 right here. And you can see, and this yellow area actually is the middle third of the distribution of where that margin's been historically. So 33% of the time it's been in that yellow area. The solid line is all the actual margin that we have to this point. And we'll have the March one today, because it's the end of April, and we get it at the end of the following month. And the dashed line is the forecast. And I'm going to get into that in much more detail later on. But that's kind of where we're forecasted. So we're actually, and if you look at this long run, the average is a little bit over $8 depending on how far back you want to go when you're defining this. And so right now the margin is, down below 7, which is low enough to get a payment at $7, $7.50, or $8 for the current month, and is projected to be recovering to above $9 later on this year. Okay, so milk prices are currently forecasted to have a reasonably nice, depending on your perspective, recovery in the second half of the year. So your operation has an actual production history, which is, if you were milking cows in 2011, 12, or 13, is defined as the highest level of production that you marketed in one of those 3 years. If you have since that time doubled or tripled in size, you still have the actual production history that was from those years. And if you participated in past years, then your actual production history grew by the growth rate that was not your growth, but was the average U.S. growth, and you can see what it was in the past years. Because you may have signed up in 2015 and or 2016, and there was an opt-out too recently, right? So you could have been doing it and then opted out, and so now you might be thinking about getting back in. And then, given your actual production history, which the good people at FSA have on file if you've participated in the past, and if you haven't participated in the past, then you could call your co-op, for example, could help you figure that out. And if you started milking after 2013, then there's ways to establish an annual production history. But given that actual production history, and then it will be adjusted, you can then pick coverage levels between no less than 25 and no more than 90% of your actual production history. So this program has been in existence, for 3 or 4 years now. And basically, there was a reasonable amount of participation at the beginning, although I personally think that looking at the percentage of milk or even the percentage of people that are signed up is not necessarily the best way to measure the success of a program that's meant to offer catastrophic risk coverage, because we would expect more participation when things look really bad and less when things didn't look so bad. And by some measures, not necessarily in this part of the country, but in other parts of the country, it hasn't been so bad the last couple of years. But nonetheless, this program has so far taken in a significant amount more in premiums than what it's paid out. Okay? So the good news is, for all of you that have participated, you're doing your part to help the government solvency position. You're good patriots, paying in and doing your part. So nobody can say that the U.S. dairy farmers are not patriots here, right? So, but that wasn't really the intention of the program. And so here's the other thing. If you're thinking about dairy policy and the opportunity for making dairy policy changes in future farm bills, then what's called a baseline matters, which is how much they're spending on each different commodity. And because we really hadn't been spending any money on this program the last few years, the dairy baseline in the next farm bill was going to be not so good, as far as it wouldn't allow opportunities to make more changes. So as part of the Budget Reconciliation Act, which was in February of this year, there were changes made basically to dairy policy in the form of the Margin Protection Program and to cotton, but we're not going to get into cotton because, as far as I know, we're not growing it here. Right? So those were kind of the two ag producer groups that had wanted to see some changes made, and they got some changes made. So in this case, for the Margin Protection Program, greatly reduced the premium costs for Tier 1, which I'll talk about what that is, which basically, in this case, is the first 5 million pounds of your covered production history. Eliminates the premiums for $4.50 and $5, which means instead of having $4 free, now you could have up to $5 with only paying the administrative fee. It cuts the other premiums by an average of 70, adjusts Tier 1 to cover the first 5 as a first, and this is covered production, as opposed to the first 4 million pounds. Lets you guys sign up retroactive to January of this year, which is going to make this year's decision a lot easier because we're going to have several months in the book. And it's going to be hopefully, relatively obvious what you should do. Calculates the potential payments on a monthly basis as opposed to the original program, which did it in bi-monthly couplets, right? And for some people, it will waive the administrative fee. Although I don't know that that's a lot of people. So $100 administrative fee can be waived for limited resource, beginning, veteran, or socially disadvantaged farmers. We had a discussion about this in Hillsdale the other day. That doesn't mean that you have bad social skills. Socially disadvantaged has a specific definition, right? So premiums apply in 2 tiers. The first 5 million pounds that you cover, and then anything above the, so this is, I'm calling tier 1, the first 5 million pounds that you cover, and then tier 2. And the reason that matters is these are the premiums. The premiums are fixed. So this is what tier 1 was, which was $4 for free, $4.50 for a penny, $5 for 2.5 cents, and so on up to 47.5 cents for $8. Okay? This is what it is under the 2018 version of the margin protection program, which is no premiums to $5, $5.50 for 0.9 cents, and then up to $8 for 14.2 cents. So pretty dramatically lower. Tier 2 now, and also, as I said, this is for the first 5 million pounds of covered production. This was for 4. Tier 2, the premium costs remain unchanged. So if you spill over into Tier 2, which you might if you're a large milk producer, if you have a lot of milk production and your covered production history ends up, can not be less than 25%, right? So, and I'll get into that in more detail. You can see it gets a lot more expensive from 14.2 cents to $1.36. Tends to eat into the net payments, okay? So one lesson here is going to be you want to stay in Tier 1 to the extent that you possibly can. All right, so this is, okay, the program has only existed in these years, okay? So it didn't exist in these past years. So this is what my calculations of counterfactual historic payments. Okay, it didn't exist in those past years, so those payments didn't happen, they couldn't have happened. And in fact, and as an economist, the reason that I'm trying to be careful about this is, had this program existed in 2009 and 2012, it might have influenced supply response. In fact, I would have expected it to a little bit on the margin. But that actually would have resulted in higher payments, not lower. So in that sense, this is likely to underestimate it. But anyway, I was curious as to what this program would have meant with the different premium structure and calculating it monthly versus bi-monthly. And so here's the old program. And you can see, first of all, 2009 and 2012 were catastrophically bad by this measure. And I think we can all agree 2009 was pretty bad. Although that's getting in the rearview mirror now, and the most recent years matter a lot more. But the point is that net of the premiums for $8 coverage, it would have been about 36 cents more over this period under the new rules. So that's kind of what those new rules are worth. Okay, so the changes clearly would result in higher payments, every year. And basically, here's the reason that this is the new. This again is assuming that we're staying in Tier 1 at $8 coverage. The green is the new rules, and the red is the old one. And so a lot of what's going on is just the premiums are so much higher at that 47.5 cents for $8 versus 14, right? Because once you enroll, here's the other thing. When you enroll, you have to pick your coverage level is for all of your milk, and it's for all of the months, right? So you can't say, I'll take the first 6 months, and then I want to opt out, or I'd like to do the first 6 months at $8 and the last 6 months at $4 and things like that. You can't do that. You're picking one coverage percentage, one covered margin. So, so if we look at this is again the counterfactual, but still, so this is Tier 1 versus Tier 2, and you can see, the payments are a lot better. I mean, this is just a function of premiums, right? So, but this is also why you want to stay in Tier 1 if you can. Okay, so timing and amount of payments. Preliminary Nass, so these are all the National Ag Statistics Service or the Ag Marketing Service of the U.S. Department of Agriculture. At the end of any given month, they will give preliminary estimates for that month of these measures, and then they give the final estimates on all these measures for determining the actual margin is at the end of the following month. So For example, we are now Friday, April 27th, and today we will have the final numbers for March. So now we've had a pretty good idea, by the way, for a while what the March numbers were, because the preliminary numbers are usually pretty close. Usually doesn't change a lot. Sometimes, but not very often. Okay? So, and you're always paid for 1/12 of the covered amount of milk production, and you also pay the premiums on 1/12. Okay? So what they do is we're not worrying about seasonality. Okay? If you produce more milk in May and less milk in November or what have you, it doesn't matter as far as determining these program payments. It's 1/12. So divide it by 12 each time. So here's an example. So the margin for February was known at the end of March. The all milk price was $15.30 a hundredweight. If we take that weighted cost for feed of Nass corn, Nass hay, and AMS Central Illinois soybean meal, it was $8.42 a hundredweight. Okay, these aren't your numbers, but this is what the program actual dairy production margin was. Ended up at $6.88 a hundredweight. If we had $8 coverage, which you can sign up for, right? Because remember, we can sign up back to January. Then we're looking at a payment, not a net, but a gross payment of $1.12 a hundredweight. If we had 5 million pounds covered, for example, which is 50,000 a hundredweight, would be 1/12 of that times $1.12 is $4,667 for the month of February. Okay, so the sign up started technically April 9th, I guess. I don't think there's been a whole lot of people signing up that day. But it goes through June 1st. So you have another month. June 1st is a Friday, I think. And we're going to have some FSA representatives talk and answer some questions here after I'm done. I'm guessing they would prefer, if you wanted to sign up, that you didn't wait till June 1st. And that's a safe statement. So if it looks like you're going to participate, by the way, and they can talk about this more, you could go and file the paperwork today, and if you wanted to change coverage or something, you could contact them between now and June 1st, right? So I'll let them talk about that. But so you have another, here's the other thing. So by the end of May, we're going to know the April numbers, okay? We'll have the final April numbers, and we'll have the preliminary May numbers, which again are probably pretty close, unless some crazy things happen, like the weather makes it so we can never get in the fields or something like that, which could affect feed costs. Okay, you can participate in LGM dairy, which is livestock gross margin insurance for dairy producers, or MPP, but you can't do both. So if you happen to be doing LGM dairy right now, you have to wait until your last contract expires before you can participate in the margin protection program. And if you do participate in the margin protection program, then you are giving up the option for 2018 to use LGM dairy. Okay? So that's something to keep in mind. I don't know, well, let me just talk about this right now since I mentioned it. But as part of the Budget Reconciliation Act that made these changes to the margin protection program, the other thing that happened that's relevant to dairy producers is they removed the cap on the premium subsidies for livestock gross margin insurance. So the way it had been was the livestock insurance policies that RMA offered. Okay, so crop insurance, the way it works is the market rates what the premium is at the current time given the current amount of information. And then if you want to buy the crop insurance, the government says, I'll pay this percentage of your premiums, of your actuarially fair premiums, which is why crop insurance is a good deal. Because if you think about it, if somebody offered to pay 35% of your car insurance, you'd probably take it, right? So, that works out. And the way the crop insurance has historically worked in this country is there's no caps on the crop insurance for what they called the commodities, which were essentially corn, soybeans, and wheat. So, last year, the government spent something like $9 billion on crop insurance subsidies. And by the way, I'm not criticizing them. I like crop insurance. As an economist, it's an efficient way to get things done. But at the same time that we're talking about $9 billion a year for the commodity crop insurance, livestock crop insurance, which included LGM dairy, and there's a beef policy or two, and there's a swine policy, and I even think there's a sheep one. in total, annually, was capped at $20 million, which doesn't make a lot of sense if you think about the value of production that are in those commodities. And so it's been something that's been kind of in the works for a couple years, and it's a good thing, I think, that it happened. But what they did is they basically removed the cap on the livestock insurance policies. So now, if you are somebody that had tried to use LGM dairy in the past, and it was entirely possible that you had put in an order for LGM dairy and that it didn't go through because they had used up the entire $20 million, which did happen, okay, you now don't have to worry about that. So it may be something that if you've looked at in the past, you may want to look at it again. The other thing is and since they've taken the cap off, there's now more incentive to create more policies. Because before, if you were an insurance provider, there wasn't a lot of incentive to create policies for dairy or livestock because there wasn't enough money out there for anybody to buy them. So there is, for example, a new policy that they're calling revenue protection, which is essentially John Newton's baby, and John is at National Farm Bureau. And that, according to John, may get approved at the end of this year. So it's not going to help you for 2018, but it may be something you want to look at in the future. So, and LGM dairy, I think, has a lot of potential. It also has a lot of moving parts because you can select the percentage you're going to cover, and it can vary by month. You can select the weights on feed. There's a lot more moving parts, which can be a good thing if you want to take advantage of it, but makes it a more complicated decision. And so, you know, I think in the future it may be worthwhile to have more. I'm going to let Faith get up here afterwards and talk for 2 hours about using LGM dairy, right? Okay. All right, so downsides of the margin protection program. As I said, it's based on the national averages. So it hasn't been as reflective. And historically, by the way, the national averages were really good for Michigan producers in the sense that until the last couple of years, Michigan really tracked historically really closely the U.S. all milk price and the feed prices. Less so now, and I think we'll get more back to that in the future. But that's not because of the program. The feed ration is fixed. You don't get to weight it more or less depending on what you're feeding or whether you're including heifers and things like that in it. And that's just the way it works. And it offers a maximum protection of 90% of your actual adjusted production history and a minimum of 25%, and both of those might be an issue depending on whether you wanted more covered or you were so big that you wanted to try to keep everything in tier 1, but once you get above. So what this means is when you get to 20 million pounds, right, and that might be 20 million pounds with the growth if you've participated in past years, once you get to 20 million pounds on your adjusted actual production history, then you're sitting right at the $5 million, or $5 million pound line, right? So once you get above that, then some of your covered production history is necessarily going to be spilling over into tier 2, which just gets more expensive and starts to eat into the net payments, as we'll see. So the farm decisions are whether to participate retroactive to January, and if you're participating, then you need to select a margin level and a covered percentage of production. So making these decisions, there are a couple of different tools that are available. And I'm going to talk about the one that's at the Dairy Markets and Policy website, which is the same one that if you go to FSA, you'll link through to. And so what that does is calculate expected margins using futures and options data, and I'll show it to you. We'll go through where it is today. And you're going to want to look at the various coverage levels, likelihood of payments. If your annual production history is greater than, adjusted is greater than 5 million pounds, try to stay in tier 1. If it's greater than 20 million pounds, then you're looking harder at whether this makes sense for you. I was trying to calculate the break even this morning, and I think it was 24 and some change got you to the point where you had spilled over into tier 2 enough to eat up that net payment. But that's going to change with the market too, by the way. So let's, this is where the website is. As I said, if you just Google Margin Protection Program Decision Tool, you'll find it. You can also go to FSA's website and link through to it there. one way to go is to go to dairymarkets.org and then click on the MPP or do /MPP. You can plug in your actual production history to make the payments applicable to your operation. And you know what? I'm going to come back to that. I'm going to go to the website now, hopefully. Okay, so this is the Dairy Markets and Policy website, which is Mark Stevenson manages. And Mark Stevenson is from St. John's, Michigan. So some of you may know him or know the family. So Mark has been at the University of Wisconsin for, I don't know, 8 or 10 years now. And before that, he was at Cornell for like 20 years. So Mark's been doing dairy policy for decades. And I'm part of this group but Mark does the bulk of the work on the website, so he deserves the credit. So if you go to this, and if you don't ever look at this website, I think it's useful, and you might want to consider it. So this is just the home page, and it's scrolling through dairy information here, futures, options, stocks, production, exports, things like that. And if you click on tools, you can get to specific ones. So, for example, and this is pulling it up every day. So you see updated 426, this is the same way the tool works. So this is last night. So what the software does is go in and pull all the relevant information at the close of the trading day. So every time there's a trading day, this gets updated. So this graph right here is where the futures market is for the next 12 months. And the Class 3 futures are red and Class 4 are green. And you can see that we're low right now. And if it went back to historic, it would be really low the last couple months, right? And the current best set of information from the futures market is that we're going to have a recovery. And it's over, 1650 and some change at September for Class 3. And as this changes, it affects the net payments and the expected payments. So I just wanted to take a look at this because if you have been paying attention, so this is the April contract, which will close. Is it close today or next Friday? Next Friday, I think. So this is Class 3 in red again and Class 4 in green. And you can see really low prices for what it was forecasting for a close in January, February. But this past month, it's been on an upward trend, basically. So, and that's been, cheese prices have been doing better, and that's been helping this. And by the way, if you looked at the expected payments for the margin protection program a month ago compared to today on that first 5 million pounds of coverage, it was $22,000, $23,000 net after you take out the annually, after you take out the net of the payments, and now it's like 13. So the expected net payment, because of this price increase, has been declining. But that's actually a good thing, because you're going to get paid on all your milk, right, as opposed to net payments. You'd rather have an actual price higher than the payments. So, but that's also by way of making note that these, especially looking forward, these margins and payments are probabilistic, right? They're based on the best information the market has at the current time, and that could change. So, although the good news this year for signing up for 2018 is we'll have a pretty solid idea. We'll know first 4 months. We'll have a pretty solid idea of 5. And that's probably going to make the decision fairly obvious for most producers. So, anyway, the other thing is, I don't know if you guys know who Bob and Mark are, right? The other thing is, if you don't do this, I'll just put a plug in here. If you go to the podcast, publications and podcasts, you can go to the Outlook one and see Bob Kropp and Mark Stevenson's Outlook, which is always good. Plus, it's entertaining because I find Bob endlessly entertaining. But that might be because I've known him forever. But so anyway, if you click on the MPP tab or do /MPP, then it takes you to the margin protection program. And this is that graph that I had up there earlier, except this is updated last night, so it has newer information. I might have changed these a little bit. So the decision tool is right here, if you can see what I'm circling. The decision tool is here. There's instructions if you want them here. There's videos if you have insomnia that you might want to watch. Otherwise, I don't know that I'd advise it, although there's some short videos on what that might be useful, I should. And then there's PowerPoints and stuff. So if you click on the decision tool, then you get this disclaimer, which you're not going to read. It says that we're going to share your information with the Russians for the next election. So anyway, it just says it's probabilistic and it's based on, the best information, futures and options, and so on and so forth. If you then click on if you agree, then what you get here is the decision tool, and you can put in your operation name if you want, because it actually can print out the form for you to take in. You can pick the coverage year, and it's defaulting to 2018 because that's what we're making the decision about. You actually can look back at historic years, and the only reason you might want to do that, I think, is if you wanted to see how accurate this thing was over time. Otherwise, if you want to play those games, and the other thing is you can put in your annual production history. So you could put in, 5.4 million pounds. One more. Okay, so whatever you would put in your annual production history, and really that won't affect this graph, but when you hit select coverage, which is right here, which will calculate your net payments, that matters. So what you want to do is figure out what your annual production history is, maybe by talking to FSA. They could tell you what it is. Or if you haven't established one in the past, maybe you need to talk to the co-op or what have you. So here we are today as of the close last night. The black line is the expected margin, okay? And then what this band is around it is, the green is the 25% confidence interval above the expected margin, and the red is 25% below. So what this is saying is that given the milk futures and options, class 3, class 4, the corn and the soybean futures and options information as of close yesterday, this is a 50% probabilistic band, which means that there's a 25% chance it could be below and a 25% chance it could be above, according to the market. Now, won't get into the weeds on this, but essentially what this does is it takes the close of the futures, and that's the expected price, and then to get the distribution around it, what we do is pull the options data, so puts and call options on these different contracts. And so, for example, if you are willing to pay a lot more money, or a whole bunch of people were willing to pay a lot more money for a call or a put that was out of the money, then the only reason you would do that is you thought there was a chance that might hit, right? So the more people are willing to pay to be out of the money, the more risk they're seeing in the market is essentially what's going on here. There's a lot more math than that, but that's what's going on here. And so this is how we arrive at this. And you can see that this gets wider as we go out in time, right? Because okay, so it's narrow here, and it's black for the first 2 months because we know those. That's not probabilistic anymore. We know it was $8.12 for January and $6.88 for February. And we also are pretty darn certain, well, we're going to know what it is for certain for March coming up here. And then April, as we go out, there's more chances for droughts, trade wars, or whatever, right? So there's more chances for risk, so this interval gets wider. But here, and then the blue area is what you can cover, okay? So if it's above the blue area, so what this is saying is that there's definitely at least a 75% chance in these months at the current market information that we won't be below $8. And that's actually a good thing. You'd rather get paid more money for your milk and or pay less for your feed. Okay, you can look at that same information by clicking on the probability table. So this is the same information. This is it in graph form, and this is it in tabular form. Hopefully y'all can see this from where you're sitting. But what this is by month through 2018, the expected, or in fact actual margin if we're done for the year. So again, 812, 688, 678, 701, 739, 775. So what we got is from February through June at the current market information, we're below $8. And then from July on, it's 8 up to 9, which is, would be great. Maybe we could even go higher. We'll see depending on what happens. And then it's got each of the different coverage levels, $4 to $8, and the probability now that the market is forecasting that it will be below that level, which might mean it's 1 cent below that level, and it might mean it's $2 below that level. I mean, you can just kind of tell by looking how far down it goes, right? So it's saying 100% chance for March, 100% for April, 92% chance below $8 for May, 66 for June, 46 for July, and then it's saying less chance going forward, okay? And this will change over time. Like I said, if we were doing this a month ago, we would have seen bigger percentages and bigger payments because the milk prices hadn't recovered as much for those months. Okay, so given the production history that we've put in, if we hit select coverage, what it does is it asks you, did you participate last year? And did you pay the $100 fee timely? Because if you did, it's going to give you the bump in production from those past years, and if you didn't, it's not going to. Okay? So, but the big thing is to make certain that you can, I'm just going to click on that. It's going to say it didn't change your annual production history, so it's 5.4 million pounds. So I'm just going to leave it at the number I plugged in there. So if you plugged in the number with the adjustments there, then you would actually want to say no on that, because it would not give you the bump. Otherwise, it's going to overestimate it. So what this says, okay, so now this is at the different coverage levels from $4 to $8, what the fees and premiums are for the entire year, given your production history and the percent that you cover, which is here. And then what the expected payments at the current market are. So this could change every day. Well, it won't change for the first couple months, but this is annually. And what the expected net premiums are, and if it's in parentheses, it's a negative number. Okay? So that just means that the expected payment is not as big as the administrative fees and premiums, right? So this operation right here with 5.4 million pounds of annual production history, if they're covering at 90%, are covering 4.86 million pounds, and they have expected payments if they choose $8 at the current time for 21,000. It's a $7,000 bill, and it's expected net returns of $14,000. I don't know why you'd want to do this, but if you wanted to cover a smaller percentage, you could select this, for example, and now at 50%, you're covering 2.7 million pounds. It's fairly obvious at this point in time that if you are, below 20 million pounds of annual production history, given the current levels, and that you probably are going to benefit from participating, and that you definitely want to adjust your coverage percentage to stay in Tier 1. Okay? That would be my advice. You do what you want. But if we get up here, let's make this 25 million pounds. If we adjust this to 25 million pounds, okay, and when I adjusted that, it goes back to 90% there. Okay, that would be a dumb idea. Don't do that. If you have 25.4 million pounds and you're covering 22.86, if you at 90%, then that, do something else with your money. Find a charity. So instead, yeah, I guess you might have more say in how other charities use your proceeds. But yeah, okay, you're right. Good point. So if we go back to 25%, at 25%, we're getting close to break even here. With 25.4 million pounds, at 25%, we're at 6.35 million, which means we've got 1.35 million pounds, or 13,500 hundredweight, which have spilled over into Tier 2. And that's eating away, because remember, at $8, we're paying $1.36 for every hundredweight above that. So we're getting close there, right? We're starting to get in. So if you're getting in that neighborhood, you want to look at other options. Margin protection or livestock gross margin program, forward contracts, futures and options, and other things like that. Because this program, as it currently is incarnated, is not necessarily going to be beneficial to you. Yes, sir.
Because we already know the past months, we actually don't have to write the check out, right? It just gets subtracted off.
You know what? I'm going to let them talk about it. I'm going to let the FSA people. Yeah, well, you know what? When I finish, that's a really good question. So the question was, are we going to have to write a check for this? And another question might be, if we sign up this week, when do you think we could get a payment for February, March, and all that stuff, details I'm going to let them talk about, okay? But that's a really good, so hold that thought. Okay, so, we could play around with this to see where where the break even is, but it's somewhere, and it depends on then how much milk per cow you're producing, right? If you had 1,000, 25,000 pound cows, this is where you'd be, for example. But it only takes 800, 30,000 pound cows, right? And so on and so forth. So, but the good news is for 2018, we're going to know. It's going to be fairly obvious. And if you're not in that 20 to million plus pound annual production history, and by the way, remember, it's where you were in 2011, 12, 13, right? It's not where you are today. If you've grown, and now you're way above that, but back then you were 10 million pounds, this is going to be a lot easier. So, or if you shrank, which doesn't happen very often, then that would be a whole other issue. Here's the other thing you can do is click on the advanced here, which gives you the same information but in a little different form. And there should be labels over here, but I don't know, for some reason my computer won't pull it up regardless of which internet program I use. But this is the all milk, the forecasted all milk price, and March, April, May, June. And you can change these if you want to play a game and say what happens if the all milk price does this. The second row, and you can pull these up on your phone too. The second row is the alfalfa price. So right now you see the all milk price is $15.37, but it's forecasting like $18.20 towards the end of the year. The hay price is just kind of flat. And it doesn't mean that's what you're paying. I don't know what you guys are currently paying for dairy quality hay, but I find that the Nass hay price is not necessarily reflective of dairy quality hay, but that's beside the point. It's the one that gets used. Then this is the soybean meal price, so $3.80, $3.90 range for the year. And this is the corn price, $3.43, $3.76, $3.80 towards the end of the year. And that will all depend on what happens with the corn crop, right? And this will depend on, what happens with soybean planting and I don't know what the current situation is with Brazil's crop, because I haven't been paying attention to that. So anyway, right now, so what this is then the all milk price is the red. This is the hay value in the ration. This is the soybean meal value, and this is the corn value. So if you take the difference between the red line and the top of the green, you've got the margin, which should be down here and for some reason isn't loading. What this is saying is that as of close yesterday, the average expected margin for the year is $8.08. But really, it's a story about two parts of the year because it's lower in the first part of the year and higher in the last part of the year. And the expected payment, if you signed up for $8 net of the premiums, is 34 cents, which is nobody's going to get rich off of, but it isn't nothing. Okay? Now, if you do want to use LGM, you should be able to click on this and have it work, but that's not loading. So if you did want to go to LGM, you should contact me, and I'll tell you how to get to the calculator, because there is a livestock gross margin insurance calculator. So if you do want to do that, that's kind of a separate issue. So, good grief, where am I? Okay, so let me just finish up here. We talked about using the tool. I think it's worth watching over time. Play with it, go in, get your numbers so that it applies to you. Pay attention to it. One more word about this. Going forward, that tool those are expected prices and margins, okay? Which is to say, it's the best estimate given the market information we have at the current time. If all of their soybean stocks go up in a fire tomorrow, that's going to change the soybean prices, and that's going to change things dramatically, right? If we decide to have a trade war with somebody tomorrow, which is fortunately, as far as I'm concerned, looking less likely, that would change things also. So keep in mind that there's no guarantee, although, as I keep saying, the good news is you're going to know 4 or 5 months. Okay? So, if it's you can't cover less than 25%. So as I've said, if you're greater than 20 million pounds, you're spilling into that tier 2, and so you're going to want to look closely at it. And we already did take a look at the tool, so just let me wrap this up. So I think about this program as a catastrophic risk management program. You know, the first iteration, which it would be common of a lot of policies, maybe had some issues to work through. That's kind of the way policy gets done. It's messy. And so, you know, they've changed it. If we have a farm bill, a new farm bill next year, it's possible that this gets changed again. The House version of the farm bill has a couple other changes to this program, which may or may not happen. The other thing that might happen is that they might roll this forward in its current form because it's an election year, right? That's the excuse. It's an election year, so it's going to be hard to get things done, except the problem with that argument is that every other year is an election year. So if that's going to be your reason for not getting anything done, we're going to have a lot of years where nothing happens, which you may or may not like. But keep in mind that the Farm Bill itself expires on December 31st of 2018. And the Farm Bill says that if we don't have a new Farm Bill, or at least an extension of the current one, that we go back to 1949 law, which includes the Dairy Price Support Program, which includes the dairy price support tied to parity, which is from the teens when the prices were much higher, which means that, do you remember the dairy cliff from 4 years ago? That whole discussion will be happening again, which means that if they didn't do anything like rolling it forward, we'd have a dairy price support that would be $41 a hundredweight or somewhere in that neighborhood, which I know would make you guys all really super unhappy. But that would have that would lead to other issues. So, you know, the best guess is that they continue this on, or maybe they make some modifications to it. But also, this doesn't have to be your entire risk management program, okay? And it probably shouldn't be. Once you sign up, you can't use the LGM. It's not triggered by your farm price, and you know, the changes to it, actually, even if you don't sign up for it, you have the potential to benefit in the future from these changes that have happened because it might pay in the future, but also because it increases the dairy baseline, which means that there's more options to do policy things in the future. So that's what I had. Are there any questions? Otherwise, I'm going to have Faith introduce your we'll be happy to talk now or later. Do you want to introduce the FSA? Sorry, go ahead.
Move forward on our annual production, or is it always going to be 11 to 13? Or does it every year progress a year?
Every year you participate, so it's currently defined as the highest of 11, 12, or 13, and then for every year you participated, 2014, 15, 16, 17, you got that bump, which was 0.86% and then 1.3%. So, and so a really good question is if they roll this forward, can you update? Okay, well, actually a couple questions. One is, would you want to update? You know, because if you were big, you may not want to update it, right? But right now, it's just growing by the percentage terms. Unless you didn't produce milk in 2011, 12, or 13, in which case there are ways you can take in your milk production checks to FSA and establish a milk production history. But right now, it's just growing based on that level. But that would be a question maybe for future, you know, would they give, because if you think about the farm program payments for, say, corn and soybeans, right? In some farm bills, you've been able to update those acreages, and in some farm bills, you haven't. And whether you want to do that probably depends.